Why this neutral call? Because we do have a lot of risks. We've got the vaccine sort of not where we thought it would be by this time in the cycle, the US-China tensions as well. But on the other hand, you would think if we see a blue sweep that there would be more fiscal stimulus, which could be positive.
Yeah, I think that's right. Good morning. So within our broadly pro-risk framing, I guess, at the BlackRock Investment Institute, so we're overweight credit, high yield, and so forth. But as you highlight, we are neutral U.S. equities. So why is that? I think a couple of things. One, as you identify, was the potential for the fiscal impulse to fade, I suppose, as the negotiations around the so-called Phase 4 stimulus were always likely to get more complicated the closer we got to the election. And indeed, that is what has happened. And secondly, of course, we are getting close to the critical risk event, November the 3rd, not too far away now, and we thought it was logical that the market would somewhat pause for thought. And indeed, I think the market has sort of failed to make a new high for the last 6 weeks, the U.S. Equity market, and that's the longest time without a new high, going all the way back to March, the beginning of this rally. So that neutral view has been probably okay, I guess, over the last 6 weeks as the market thinks about stimulus, election, and all of the other very busy calendar events in the US at the moment.
We've got a chart on the screen now. I know you can't see it, but it's just actually showing that Europe and UK equities have been left behind. You're overweight European equities, though, here. What's behind that call, given it looks like we are seeing a second, or even if you want to call it a third wave of virus infections coming through in Europe?
I think that's right. And so our overweight Europe call, which has finally had a sort of mixed result, was predicated on two main what we thought were facts. One, greater stimulus flowing through, going back to more harmonization amongst the fiscal authorities, and two, a better virus experience. At least that was the case at the time. I think as that becomes less clear, particularly the virus, which unfortunately, as you're saying, Juliette, is looking more challenging in Europe and the UK at the moment. I think as that continues to evolve, I think we're going to have to think carefully about the Europe view if, as I say, the key pillar of the virus being a little bit better is less clear moving forward.
Pretty much every day we're being inundated with calls in our inboxes about what a potential blue sweep would mean. We know that we have to factor in that in 2016 the polls were wrong, but what does this mean for the Treasury market? Is it as simple as saying more fiscal spending does lead to higher yields?
So I think that maybe the key election is actually going to be the Senate. So I think we're all very reluctant to overly believe polls, but I think we would all agree that it looks like there is at least a potential for a Biden White House. But beyond that, I think the difference between a Biden White House with a Republican Senate versus a Democratic Senate, that difference is extremely likely to be extremely meaningful, not least in the fiscal space, where a blue sweep could create potentially 3 or 4 percentage points of incremental fiscal thrust each year for the next 3 or 4 years. So in terms of the supply that would need to come to market, it does seem indeed that a blue sweep would have a meaningfully different implication for supply than a mixed government outcome. Almost regardless of who's in the White House, that mixed outcome would be different, of course.
Ben, when you look at the juice, trying to get some juice there, everybody's after a bit of yield, and you're very overweight high yield. Isn't that a bit dangerous, given that they've got this implied probability of many defaults taking place? I believe you think that that's a bit overdone, that pessimism there. But we can see here from this chart how these premiums have been falling. So tell us about where you've been looking for this high yield.
So I think the first point to make is where we are incrementally not looking, which is developed market government bonds. So the first sort of trivially obvious but nonetheless very important point is developed market government bonds don't give you what they used to in terms of yield and diversification. And as I say, that's kind of obvious but nonetheless profoundly important. So our framing at the BlackRock Investment Institute is it makes sense to own fewer of them, given they don't give you what they used to, and more other assets as we all try to solve the ever more complex argument of question, I should say, of income. And as part of that, high yield, we think is an important part of the solution. Even with the move that we've seen, we still think that there's more to go, if you will, and that the implied default rates, of course, high yield by definition is inherently a bit riskier. That's just true, but we think that the yield pickup that one can earn justifies that slight incremental risk.
And Ben, what's your takeaway from the data we've been getting from not just the US, but globally? I mean, of course, the numbers out of China the other day is suggesting a V-shaped recovery there, giving a bit of a fillip to optimists.
Yeah, that's right. So I would say we are broadly in the more constructive camp. We believe in an activity restart. Of course, we, like everyone else, are monitoring the virus evolution in Europe and other parts of the world. But in and around the activity restart, we continue to think it's the right framing. And in China, as you are alluding to, China has already fully recouped the lost GDP in the first half, so GDP back to an all-time high. And I thought, obviously, every statistic in China is sort of astonishing, but I thought one of the interesting, astonishing statistics over the last couple of weeks was the reality that 650 million people traveled during the Golden Week holiday. And that's not really an economic statistic, but I think it speaks to a regaining of confidence amongst the people, I suppose, to get back out there to restaurants, cinemas, and indeed travel to go and see families. So the recovery is not fully complete, but I think that's a particularly encouraging sign of a degree of normalization in China, which obviously, hopefully, all of us are going to be moving towards in the weeks, months, and quarters ahead.
Yeah, I'm sure you and I are waiting, and Rish, for this Hong Kong-Singapore bubble to open up as well. Let's talk about the yuan, though, just very quickly, Ben, because on and offshore at these July 2018 highs, how long does this last before some kind of intervention?
So I think the China authorities have got a really interesting choice in that they sort of have a problem of too much strength across the board. And I think in order to let some of that strength go, as it were, it seems to me that the strengthening currency can continue. Because if China chooses to lean into that by, let's say, cutting rates, which I think would be extremely unlikely, they might accidentally create a too positive housing market, which would be perceived to be socially disharmonious. So I think many people came into this year expecting that 6.8 would be sort of as strong as authorities were happy to tolerate. That was wrong, and it seems increasingly that China's currency can continue to appreciate now at roughly a two-year high, and so far it hasn't really caused any challenges or too many challenges domestically. So I would have thought the economics of very significant surpluses plus capital inflows driven by the very large interest rate differentials, China versus the rest of the world, I would have thought that basic economics will continue to see currency strength in China continue.